Hello, my name is Chuck Urey and co-founder of Main Street Investors. I've been in the business for over 30 years helping people with their investments. Today I want to talk about the third myth for investing that we talk about all the time to our clients, and that is track record investing. Before I get started, I want to tell a story. I've been in the business since the 80s, and when I was young, the firm that I was with, we'd always at lunchtime, we'd have a wholesaler from a mutual fund company come in, and they would promote their best funds, and we would sit there and listen and nod because that's all we knew to do, and that's what we were told to do. And then we'd go out and sell them. That was be the funds that we were selling because, hey, they're hot. They're the top ones. And what would happen? They wouldn't stay there. And that's track record investing, looking at past performance and making a decision because you think, well, that's going to happen in the future. That's predicting the future. We can't predict the future. We don't have a crystal ball. So, track record investing does not work over a long period of time. If you look at the top quartile for mutual funds each year, they have the top 25%, and you look at them and go, wow, they did pretty good. And they did. But it's not the same funds in that top quartile every year. That's the problem. They don't really get into that. So it's a problem. It's a myth because it is predicting the future but looking at past performance, and it doesn't work. So what's the solution? Keep it simple. First, you invest in stocks. And it doesn't have to be all in stocks. I mean, we can have a portion of it in bonds, and it the volatility isn't quite so bad when you have part of it in bonds. So next, we want to be globally diversified. We just don't want to be in the United States stocks. The United States isn't always the top place to be. So if we're diversified globally, it works. And finally, we always need to rebalance. Earlier, I talked about the portion of it being in bonds. Say 60% of it was equities and 40% in bonds. And then we have a 2000 or a 2008 or a 2020. So what happens? The equities and the stocks go down. So you take some of the bonds and you buy low and you rebalance to the 60-40. It's real simple. It's hard to do by yourself, but it's a simple concept. Thanks.